Hello and welcome to this special episode of Market Masters. The markets have had it tough for the last many weeks now. One person who turned cautious early on, perhaps the earliest of the lot, has been Sanjeev Prasad of Kotak Institutional Equities. He has been proven right. He's joining us right now. Sanjeev, great to have you with us here on the program as always. Thanks very much for your time. You were, of course, early on and steadfastly cautious through and I dare say you were wrong for a while. But I think now, of course, it's out there for everyone to see. So where does, after what we've seen in terms of the correction, the small cap index has lost about a quarter of its value from the highs. The mid cap index has lost about 20% from its highs. Where does it leave us, pure valuation-wise, Sanjeev?
Well, it's the same thing which we have been saying for the last 1 year or so. And if you look at the valuation of the large cap index, let's say the Nifty 50 index, it's not too bad, roughly about 20 times 1 year forward, about 7.5 on a March 27 basis. There will be earning downgrades, I'm sure, in some of the sectors. But broadly speaking, I don't see too much downside, as far as the large caps or some of the large caps are concerned, namely the financial names, IT, pharma, etc. Yeah, there are still pockets of overvaluation even in the large cap, but I can live with that. The problem still remains in the mid cap and small cap, areas that is sector be dominated by mid cap, small caps, or the mid cap, small cap stocks. Still a lot of froth over there, and I think you would see a lot more correction over there because the fundamental value of many of these companies are far lower than whatever the current market caps and prices are. I mean, you talked about RVNL. Just now. I mean, the market cap of the company is something like 75,000 crores even now, by the way. I think it is still at about 8 times book value, if I remember the book value correctly, and about 40 times on March 24 profits. And the railway budget this time around, there's no growth in the railway budget, right? So where is the growth going to come from for some of the railway stocks which had become very, very expensively valued? So there are still pockets of, I would say, froth in the market, and that will get flushed out over the next few weeks. Looks like the way the market is going.
Sanjeev, I was looking at this data point in the morning. If you look at the small cap index, right, with this correction we've seen, the 10-year CAGR now has fallen to about 11%, which is in line with the long-term average now. The mid-cap CAGR 10-year is now about 14%, is 14%. Again, it doesn't seem, I mean, that excess or excessive kind of fraud seems to be out, but of course these are averages. The other point is markets rarely settle at averages, right? They overshoot and then they undershoot. But you're saying on an absolute basis as well, and you gave us that example of RVNL, there are large pockets of overvaluation and excesses, right?
Absolutely. There are just so many stocks here, especially in the mid cap and small cap areas. So either you have companies which are trading at very expensive valuation but have decent fundamental. These are the high growth companies, let's say in the capital goods space, EMS, etc. But we just struggle with the valuation of these companies, and they are so much priced to perfection even now, by the way, despite coming down 20-30% from their peak levels. So any disappointment, you would see a big cut in the market price over there. And then you have many other stocks which are not displaying any great numbers, especially on the consumption side, and the valuations are still very, very rich, and in most cases the multiples are significantly higher than the pre-COVID levels, and the growth is significantly lower than the pre-COVID levels, so which makes no sense really. And in many cases you are seeing a lot more disruption, medium-term challenges, structural issues cropping up, which were not there 5-7 years back when the market was willing to give much higher multiples to the same sector in stocks. And then you have a bunch of completely rationally valued, sectors and stocks which have no real fundamentals, but the prices have gone up, very high for whatever reasons, and now they are giving way, and these will correct really, really badly, and unfortunately a lot of retail money is over there from whatever I've looked at some of these stocks.
Which are these, Sanjeev? The ones that are looking absolutely still insanely overvalued and where earnings are just not justifying? Or which pockets? I mean, if not stocks, which pockets?
Some of the PSU. Look at the PSU names in railways, metals. You will get a very good sense.
Okay. By the way,
electricity. I mean, not the large cap ones like let's say
Yes, please
Sorry,
continue.
I was just
Please
saying
continue.
that NTPC, Power Grid, etc. may be okay, more reasonably valued now. I was just saying NTPC, Power Grid, etc. may be more reasonably valued. But look at something like a BHEL, which we have been sounding cautious for the last 1.5 years now. The stock went up from whatever, less than 100 to 300, now down to below 200. I still think it's supremely overvalued. It will come to below 100, or rather, I should say, I can't forecast stock prices. The fair value of the company is below 100 in my view. It's still my view, but that's what it is. I can give you the math on that, but anyway, let's keep it.
Got it. You're saying even within PSUs, there are the likes of NTPC and Power Grid where you think now the corrections made the prices a little reasonable, but BHEL you'll hold your verdict on that one. Sanjeev, just very quickly at a headline level, I was looking at, for instance, some of your peers, Motilal's note. They were saying for FY26 that Nifty estimate is around, I think, 1,203. And they feel that expecting a 15% CAGR is very excessive right now. Where are you on the headline earnings trajectory for FY26? Whether it's the Nifty 50 or the BSE 200, some of the wider indices, what is that big number that you are going with?
So for FY2026, we have 14.9 or 15% growth, let's say, rounded out to 15%. That's on the back of 4% growth in FY2025. But anyway, 2025 numbers are distorted by, much weaker numbers for the likes of BPCL, HPCL, which is not part of Nifty, but through ONGC, these numbers come. And also coal had, very high numbers in FY2024. We will have a big decline over there compared to FY2024. So if you look at without these three companies, which is probably right to look at it because there's a lot of volatility in the numbers of these three companies, then the FY2025 net profit growth will be 10%. And for FY2026, now, as of now, we have 14% growth. And I think the EPS number is about 1180 or so for FY2026.
You're saying
so again, the Nifty is not a problem. If you look at the banks are reasonably...
Sorry, Sanjeev, you're saying the Nifty...
14% growth, if you take...
Yeah. And X of which companies did you say that the growth number comes down to 10%?
BPCL, HPCL, and Coal India. HPCL is not in the Nifty, but its numbers get consolidated with that of ONGC, and ONGC is in the Nifty 50. And there's a lot of volatility in the numbers of these companies. By FY2024, if you recollect, you had very, very high profits for BPCL and HPCL. And also coal had this one-time benefit from the change in their accounting policy for the overburden removal, which boosted 2024 numbers significantly. Which is why if you look at the FY2025 headline number, it is only showing a 4% growth. So that's why we now remove BPHP and coal from the calculation completely. And if you do that, then the FY2025 Nifty net profit index, Nifty 50 index net profit growth comes to 10%. And on a like-for-like basis for FY2026, it comes to 14%. So there will be some downgrades, but I think 12-13% it seems achievable for the Nifty 50 as a whole. See, Nifty 50 again is not a problem. You have companies, like the banks, etc., which are not seeing really any challenges as of now. Or especially the banks which are Nifty 50. There are smaller banks who are seeing a lot of issues in the MFI, loan book, and so on and so forth. But there are no real asset quality issues as far as the larger banks are concerned. If you look at IT, pharma, which are another very large portion of the index, they are getting some tailwinds from the big INR depreciation that you have seen, and some recovery, and anyway, pharma companies are doing quite okay. So that's not the problem. The real problem, as I keep saying, is beyond the large caps.
Where do you stand on foreign flows, Sanjeev, from here on?
See, foreign flows, I suspect, we should assume for the time being it's not coming back in a big hurry. And the reason for that is pretty simple. There is no new money coming into emerging market funds for the time being. And I don't see why that situation should change in the next 2-3 months at least, given the fact that the US market is doing very well. We have a lot of, policies which are still evolving, as far as the new US administration is concerned, which could work against the EMs for, if you see more, tariff being put on exports from some of the emerging market countries. So as of now, I would say most asset allocators would be a lot cautious on emerging market. And that's been the theme for the last, 3-4 months now. This whole thing started from late September when, first of all, I'm talking more from India perspective. First, you had the India to China pivot when China announced, a host of policy measures, fiscal and monetary, to reboot the economy. And very quickly, by end October, when the chances of Republican Party winning all the three arms of the U.S. government, started to build up, the so-called Trump trade, you had a pivot from EMs to the U.S. And that trade, unfortunately, has continued, from a perspective of EMs. And you see the fundamental problems still remain the same, right? If you look at the performance of emerging markets, it's been a disaster for the last 10 years. The MSCI EM index is up 13% in the last 10 years, cumulative that is, which means 1% CAGR. Against that, the S&P is up 200%, so that means 3x. Nasdaq is up about 300%, that means about 4x, by the way. So that's the comparison an asset allocator, which could be an endowment fund or a pension fund in the US is looking at. And everybody looks at trailing returns, and decides, okay, fine, US is the market to be in. Plus, you don't have worries about, currency and so on and so forth. So why bother? And I suspect that may continue till the time either something goes wrong in the US, but obviously then it means pain for the rest of the world also. Or, somewhere EM valuation come to a level where, people, start looking at it a lot more favorably, which is what seems to have happened in the case of China at least. Valuations were attractive. Certainly you have this excitement around, DeepSeek and AI-related tech. You have seen all the tech companies, bouncing back, and also China has decent, tech companies. So that is excitement now, but remember, it is basically the same money which is rotating between various EM markets. And unfortunately, India will not get any money in the process, because if China's market is doing well, India will probably struggle, which is the second leg of the problem. So first you have an EM to US problem. Second is, as of now, looks like again you have India to China pivot, which is going on.
Absolutely. And final question, where does it leave us then? Does it leave us, is the best case a time correction? The market does nothing, spends the whole year consolidating. Is that the best case? Or is there still the possibility of seeing more downside, despite the mutual fund support that the market has got the last so many months?
It ultimately depends on how the retail investor, takes this period of pain, which has been there for the last 12 months now, come to think of it. If you look at the Nifty 50 mid-cap index, Nifty 100 mid-cap index, I think it's up only 3% in the last 12 months. Nifty 100 small-cap index is actually negative last 12 months now. So, and the last 3 months have been pretty ugly for both mid-cap and small-cap indices and stocks. See, there are some interesting data points. If you have the time, I will share. See, there are two issues over here. When people believe Indian retail investors have done very well, keep in mind the fact that you have a lot of new investors who come to the market in the current financial year. About 8 million out of 53 million unique mutual fund investors have come in the last 9 months here. And these are investors who I don't think will have the risk appetite to bear a big market correction. So how they are behaving, I don't know, but I'm sure there could be some signs. I suspect there could be some signs of panic over there.
Welcome to this Market Masters special. Investors and traders are on their edge with tariffs from the US and the threats of tariffs. In addition, the US has reported high inflation and strong labor data. Does all this mean the US exceptionalism will continue? Will foreign funds continue to pull out of EMs like India? And when may the trend reverse now that the rupee and stock indexes have fallen quite a lot? For all these questions, I'm joined by Viktor Shvets, the global equity strategist at Macquarie, and by far one of the best veterans of emerging markets and indeed global markets. Mr. Shvets, thank you very much indeed for your time. I have a lot of tariff questions, but let me first start with this fund flow question. Since October, India has only seen funds moving out of India and other EMs into the US. How long will the US exceptionalism continue, you think?
Yes, I think if you think of large economies globally, very few can add labor, capital, and grow multi-factor productivity at the same time. United States is one of them. But another thing to remember, the reason United States is growing so fast, because public sector is aggressively de-saving. So in other words, United States is running primary deficits, not absolute, primary deficits of about 4% of GDP. You can compare it to, say, Germany, which is way under 1%, and the same applies to European Monetary Union. It's double the level of Japan. So it's a mixture of domestic productivity and a very significant de-saving in the public sector in the United States. So what U.S. is doing is basically sucking the growth from all over the world into the United States.
Yeah, reciprocal tariffs are definitely upon us. That's very clear from the executive order. But will that continue to attract more money into the U.S. markets?
Well, there are a couple of questions in there. Number one, why do you need tariffs? Do you try to implement tariffs in order to raise revenue, in order to pay for tax cuts? Are you doing it to level the playing field? Are you doing it to rearrange savings and de-savings? In other words, unless we trade with Martians, unless we trade with extraterrestrials, all savings in the world has to be equal to all investment. So if you try to rearrange it, then by definition, countries like China, Japan, Germany will have to consume a lot more, and the United States will have to save more and consume less. That actually could diminish exceptionalism. In other words, the growth potential, the growth, ongoing growth, not potential, will actually come down. So it's not totally clear what Donald Trump is trying to achieve, whether it's a negotiating tactic in order to get a slightly better deal for U.S. corporates, whether it's beefing up and giving some meat to the base and ensure that the base feels that he is working very hard for American people, or whether it's a genuine desire to rearrange the pool of savings and investment and spending on a global basis. Remember, we can go back to Paul Walker and Bernanke when they were talking about surplus savings and how we need to rearrange the world. So those are the three very different answers. My view is that there is no particular consistency. He's trying to do all three. He's trying to make sure that the base is behind him. He's trying to bring something to the United States. He's trying to rearrange the world, but there are significant constraints. The biggest constraints he is facing is inflation in the United States, is Federal Reserve, as well as electoral outcomes. Because remember, within 12 months, we will be talking about midterms.
Okay, now to my more important point, what are your views on India? We have already seen steady outflows of funds. Now, at what point do you think India will look attractive to you?
I think my view has always been that investors are too bullish on India. In a sense, expectation of 7 to 8% GDP growth rates cannot be fulfilled by India as it stands today. If you want to get to 8%, either capital efficiency have to be a lot higher than what India is delivering, or you have to improve dramatically domestic productivity, including agriculture, or more importantly, public sector has to de-save a lot more. In other words, public sector deficits has to be running at a much, much higher level. However, having said that, if you think of India, again, it adds labor, it adds capital, it's gross multi-factor productivity, which somewhere around 5.5 to 6.5%, call it roughly 6, should be the optimum level at the current positioning. If you want to lift it another 100 or 200 basis points above that, as I said, you need to address those three buckets. Now, if we think of close to 6% real, that's about 9 to 10% nominal. That's more than double the nominal GDP that China, for example, is capable of delivering. And so at that level, you would say earnings per share in India probably need to be in low double digits. You probably should be looking at 11, 12, 13. The problem is expectations are much higher than that. You're really looking at expectations of 16, 18%. So the way I look at India, India is a case of growing into growth, which is, in essence, a much better problem than trying to extricate yourself from the liquidity trap that, for example, China have found itself in. So China, to me, is a safe harbor during a storm.
Do you see growth returning, earnings growth returning? Do you see India re-emerging as an attractive investment option sometime in calendar 2025?
No, I still think that earnings per share are too high. As I said, currently expectations are 18, even 19%. They really should be at least 500 basis points lower than what they currently are. And that's why I'm calling growing into growth. Now, when would India perform? Well, there are two things. Number one, certainly in the last 6 months, U.S. sucked in everything. So U.S. growth rates was exceptionally strong. As soon as there is a perception that the United States is becoming more volatile, in a sense that you don't really know what's going to happen, there is some degree of reversion back into other markets. Give an example. If Donald Trump is actually successful in freezing Russia-Ukraine conflict, if commodity prices will go down, especially energy, clearly people will be rotating into European Monetary Union. That's one of the easiest calls to make. The same applies to emerging markets. As they correct, you actually will have a rotation into emerging markets as well. So to me, it's very hard to predict whether that happens in a week or two or whether it happens in 3 months. To give an example, Europe, just in the last week, already outperformed the United States by 5%. That's a very significant move in what is only a few trading sessions.
Okay, let me come back to tariffs. Where does this tariff war stabilize? And who will be the winners and losers when things stabilize?
Right. Well, if you think of U.S. tariffs prior to Trump 1.0, they were roughly between 1% and 2%. Trump and Biden actually raised it to somewhere around 3 to 4%. My base case scenario remains that probably tariffs are going to roughly double. You could be looking at 8 to 10% average tariffs. Now, that will not pay for the tax cuts, coincidentally, because that will not generate any more than $1 trillion or maybe $1.5 trillion over 10 years, whereas a hole in the bucket is something like $15 trillion. So it will come nowhere near what is needed. But to go beyond that is creating a major problem. Because if you only raise the tariffs, let's say to 8 to 10%, the incremental CPI impact in the US will only be maybe 20 bips, maybe 30 bips at most. Because remember, US is not a trade-dependent economy. It's broadly just domestic economy. But if you start going beyond that, if you start going to 15, 20%, this is when you'll be looking at 100 basis points at least high CPI. So the way I look at it, there is constraint on what Donald Trump can do, because the reality is 2 or 3% of the voters who switched to Donald Trump, because that was the magnitude really of the entire switch, did it for what I call 3 I's: inflation, inequalities, immigration. So he can't break those things because then electoral impact will be significant. So to me, there are still the guardrails. Now, there are other guardrails people are looking at, things like congressional and legislative, state and local level, corporate, lobbying power, judicial. But the biggest guardrails, I think, are inflation rates as well as the Federal Reserve and what Federal Reserve is going to do going forward. Now, could he decide that the pain is necessary for a bigger picture? Possible. And I think that's what people are nervous about. But I think at the end of the day, he's pragmatic. And I think a more pragmatic answer will prevail.
Would you expect dollar to remain strong for a better part of calendar 2025?
Well, actually, the way I looked at it when we previewed 2025, that US dollar will start higher, much higher. But then actually by the end of the year, it might start easing a lot. And the reason is, if I resolve those uncertainties, if I resolve German election uncertainty, if I resolve the Japanese uncertainty, if I diminish the probability of extreme outcomes in the United States, if I diminish some of the geopolitical outcomes, and we can talk of Abraham's Accord in Middle East, we can talk of Russia-Ukraine freezing, then what you're going to find that US dollar could actually weaken. Now, I know it sounds ridiculous today when US dollar is so strong, but to assume that DXY will go to 115, 120, 125 is really to assume a massively dislocating scenarios on a global basis, which I think, despite all the noise, is probably unlikely.
Thank you, Viktor Shvets. It's always a pleasure listening to you. Thank you very much for joining us. Well, that's it on this edition of Market Masters. Thanks for watching.